Hello everyone, my name is Dan Holloway. I'm the Vice President of Originations and Acquisitions here at Sustainable Capital Finance. I'd like to welcome you all and thank you for spending some time with us. Today we will be covering a new finance offering that's going to be financing a new technology for us, and that's electric vehicle charging. We think it's going to be very popular with our off-takers and we can't wait to share it with you. One quick housekeeping note: if you have questions during the presentation, can you please go ahead and type them into the chat box, and we will be providing responses during the Q&A session at the end of the call. So with that, let's jump in. Here's a quick overview of what we will be covering today. First off, we'll provide some background on sustainable capital financing, who we are, what we do. Then we'll be walking through what we believe is both the incredible opportunity that EV charging represents and the multifaceted value proposition we can offer to you and your customers. We'll be providing a quick overview of the EV market itself and how we believe this explosion in EV demand is going to be affecting the EV charging market overall. We're going to be providing you with some real-world examples of live projects that we're working on so you can better understand how the numbers work and what this opportunity really represents. And then finally, we'll be wrapping up with a Q&A session at the end so we can make sure we get to any questions that you may have. So a quick recap on SCF. We are a third-party financier. We work primarily with commercial and industrial projects and some small-scale utility projects as well. To date, we've primarily acquired solar and storage assets, and now we're making an aggressive push into the EV charging space. Our customers are primarily made up of solar integrators and developers. The majority of the projects we financed are in the commercial, municipal, and nonprofit sectors. We've transacted over $150 million in DG assets, and our primary funding partner is NextEra Energy, which is the largest independent power producer in the world. NextEra currently owns more than 20 gigawatts of solar and wind assets and has a market cap of more than $145 billion. The demand for electric vehicles in the US market is increasing at a very significant pace. What is really lagging, however, is the public charging infrastructure to really support all these new vehicles as they hit the road. And we think this provides a substantial opportunity for property owners to participate in this build out. Essentially, the US needs to replace millions of gas stations across the country with EV chargers. And for property owners that want to provide EV charging to their customers, SCF can provide some significant benefits. SCF can provide EV fast chargers with no upfront costs and no ongoing costs for operations and maintenance. SCF can provide a revenue share agreement so the property owner can share in the profits that are generated. And also by doing so, the off-taker can begin to monetize parking spaces that previously were not generating revenue. We can provide a new property feature that's in high demand. EV owners are consistently looking for new fast charging locations because there are currently very few of them available in the market today. And by adding EV charging, the property owner will be attracting new customers. And interestingly, these new customers will have to spend a significant amount of time at their facility. Even with fast charging, the EV owner is still going to need to spend 20, 30, maybe even 40 minutes at the off-taker site, and will probably be looking for something to do. If the off-taker sells products or services, there's a good chance the person charging their car will want to investigate what the property owner's business has to sell. And essentially, we're creating a captive audience for that business owner. And lastly, the off-taker will know they have companies like SCF and NextEra who are going to be standing behind those assets and managing them and managing the ongoing operation of those. So I kind of think of it as a win-win for the off-taker. They get new customers they wouldn't normally attract. Those customers have to spend significant amounts of time at their facility, so there's the potential for additional sales. And the property owners generating charging revenue in what was previously parking spaces that generated no revenue. So it's an interesting collection of potential benefits for the property owner. Let's talk about how many EV chargers are going to be needed in the next 10 years. In 2020, 300,000 EVs were sold in the US, which really only accounted for about 2% of total vehicle sales. But that number is expected to ramp pretty substantially up to 1.4 million units in 2025 and 3.5 million units, or 11 times 2020's unit sales in 2030. And when you add up all of the EVs that are expected to be sold between now and then, over 18 million EVs are expected to be on the road by 2030. And to support all of these, it's expected that the US will need to add over 9 million EV chargers in the next 10 years. In terms of fast chargers, I looked it up. There were less than 20,000 units available in 2020. So we have a long way to go to get to 9 million units. So there are some significant challenges for both developers and financiers when it comes to providing solutions to the EV charging market. And while identifying best candidates in terms of site locations is definitely important, I think one of the more challenging aspects for developers is really this broad array of available EV charging incentives, grants, taxation, things like that, and then how you go about modeling each of these to come up with financing solutions that really work. The incentives can be based on multiple factors and they vary by location. So just sorting through all these details can be both confusing and time consuming, and ultimately it's just a lot to contend with. In addition, the off-taker can be faced with substantially higher energy usage and potential demand charges, and this can be really costly if not managed properly. And lastly, this is still a relatively new technology, so project execution and implementation can also bring about their own unique challenges. So what really makes a great EV charging site? Well, primarily you want to have sites that are close to major public thoroughfares like highways, freeways, or other well-traveled routes. People don't want to go 20 minutes out of their way to get to a fast charger, so the closer a site is to their normal driving patterns, the better. In addition, the site should have relatively open and accessible parking spaces so people can get in and out quickly and easily. And while it's not mandatory, it can be helpful if the local utility provides EV tariff structures that don't have high demand charges tied to them. In terms of use case, we see three basic use cases for property owners. The simplest case would be a public charging site where chargers are available to anyone and everyone. You see these a lot in grocery stores or other retail parking lots, and sometimes in city-owned parking lots as well. Next use case would be fleet charging. This would be for off-takers that own a fleet of electric vehicles. Think of a company like Google or Facebook that owns their own fleet of buses for their employees, or maybe a city that owns a fleet of EVs for their employees to use during things like, inspections or other governmental business. The idea being that these types of customers are really only using the chargers for their own internal needs. And then lastly, you could imagine a hybrid model of both of these, where the off-taker may use chargers for both their own requirements, but may still want to offer public EV charging to their customers. So one example of that might be a car dealership that needs to charge its own vehicles for sale, but then may also want to offer EV charging as an amenity to their customers. So the good news here is SCF can structure our agreements to accommodate each of these models, and we can offer unique financing solutions that will meet the individual needs and wants of all three of these. So with that, I'm going to hand this off to my associate, Joel Binstock. He's going to be walking you through SCF's model for supporting EV charging, show you a couple of real-world examples so you can better understand and appreciate the opportunity we're providing. So with that, take it away, Joel.
Well, thank you, Dan. So while we've identified some of the challenges facing introducing electric vehicle charging infrastructure, we have yet to talk about some of the solutions. So let's go ahead and do that now. One of the easiest ways to mitigate some of the energy costs associated with electric vehicle charging infrastructure is to incorporate solar and solar plus storage solutions. Now, what do solar and energy storage solutions do for the overall project? Well, number one is they increase flexibility. By adding these two systems, you're able to mitigate some of the charges that can be anticipated by exclusively utilizing EV charging solutions alone, such as demand spikes and high time of use charges. By utilizing solar and energy storage, we're able to maximize the benefits from utilizing cheap solar-powered energy to charge up these electric vehicles and mitigate some of the demand spikes from EV charging. This can overall improve the project economics for the property owner, leading to a much more successful and appetizing product. So let's break down a specific example of a solar plus storage plus EV charging solution. And note that this project is scalable and can be applied across multiple sites, which we'll get into on the revenue side. So for this example, let's assume a 200 kilowatt carport canopy alongside a 500 kilowatt 2-hour battery and 4 DC fast chargers at 175 kilowatt rating. Now this project totals over $1 million, but as a reminder, Sustainable Capital Finance provides 100% of the capital cost to build this project. Now let's move into the revenue side. If we're assuming that the past solution on the past slide is multiplied across 5 sites, we're looking at 20 fast chargers, and if we assume a 10% revenue share and a 2% annual escalator, we're anticipating that the property owner will receive a net operating income of over $100,000 per year. In addition, we anticipate that this will increase the property value substantially for the property owner and will allow them to have flexibility in future years to improve the overall property in other facets as well. One of the challenges that Dan mentioned earlier has to do with project execution. And this is where SCF, with our decades of experience, can provide the solution. If you simplify the process and improve the overall transaction timeline, you can increase conversion rates. And that's what we've done with this 8-step process. Starting with QuickQuote. If you're unfamiliar with QuickQuote, that is our indicative pricing software enabled on the SCF Suite, allowing our developers and integrator partners to price projects live in as little as 30 seconds. Viable projects are then created in the SCF Suite, where more info can be collected with regards to the customer, the site location, and the project to generate both a proposal, which I'll go over later, as well as a term sheet. Projects can also be submitted for review for our project analyst team, and that process takes as little as 72 hours. Afterwards, a term sheet is typically issued, and that is when SCF recommends we kick off a call with all parties. That can help improve the overall transaction timeline throughout the process. Once that term sheet is executed, that's really when the SCF diligence process takes in, and it really can be broken down into 4 major categories. Number 1, we'll be underwriting the property owner. We'll just make sure that everything is okay with the property and that there's no encumbrances on our abilities to access our system throughout the length of the term. We'll also underwrite the system itself, and that includes all the equipment, making sure that they're Tier 1. We'll also underwrite and review a statement of qualification from the installer to make sure that they have experience installing the similar type of project. This diligence process takes as little as 2 weeks. Afterwards, an EPC agreement is typically issued to the installer, as well as the revenue share agreement is issued to the property host. So with that, that's our simplified process, and I'll go ahead and dive into the SCF Suite so you can see just how easy it is to run a QuickQuote. Okay, so let's go ahead and run through an example on the SCF Suite utilizing QuickQuote to generate indicative pricing for a solar plus storage plus EV charging solution. Simply click on QuickQuote, which will pop up a project type option. As this is not a solar or solar plus storage PPA, we're going to go ahead and select the third option, which includes electric vehicle charging. Let's use this name Demo. For this example, let's use the state California. For solar, let's use the same system parameters that we discussed before. And for the build cost, let's assume $2.50 a watt. For the battery, let's use the same parameters as before, 500 kilowatt 2-hour battery with that same $400 per kilowatt hour cost. This is where you're able to add in the SCHIP. Simply click SCHIP, select the utility district that it's in, and the incentive rate shall populate automatically. The number of charging stations, let's use 3 for this example, with the same rating of 175 kilowatts. For charger hardware, let's go ahead and select charge point. And for EVCS incentives, let's go ahead and leave that blank for now. After clicking calculate, you can see that we can support a 6% rev share with the property owner. So the developer will receive $2.50 per watt for the solar, $400 per kilowatt hour for the energy storage, and the EV charging stations are included in SCF's model in terms of the project cost. Once again, the property owner will receive 6%. But let's say the developer was able to lower their price to $2.40 a watt. How would that impact the revenue share? All you have to do is hit calculate, and you can see exactly what that'll do. In this case, it'll increase the revenue share from 6% into 9%. And at the top, you have the option and the flexibility to solve for your build costs with a known revenue share or solve for a site lease. This provides a lot of flexibility for you as a developer and originator to maximize your returns while meeting the customer's expectations. Once again, all I have to do is hit calculate at $2.40 a watt, and it should spit out that 9% that we saw before. If all these project parameters make sense, now is the time to create a project. Simply click on Next. It'll ask you and prompt you with the question, do you like these terms? If you request that the terms need to be improved, or if there's something wrong with your model, you can always select they need work. That could prompt you to have a conversation with one of our project analysts. But let's assume that they are great in this particular case. You can choose your next step by once again chatting with one of our project analysts to review any of the project parameters that you've entered in. Or you can go ahead and create a project, which will create a data room where you can upload all the preliminary designs, financials of the customer, and other additional information, as well as you will be able to generate that preliminary proposal that I told you about that we'll go over very shortly. So I'm going to click Create Project. Now this will be the project page where you're able to enter information about the off-taker, as well as information on the project details on the second page. On the third page is a data room, like I mentioned earlier, and the last page is a summary which will highlight the project parameters, and you'll be able to generate the proposal from there. So let's go ahead and open up a proposal example that you can see. As you can see here, this is our preliminary proposal for electric vehicle charging solutions. At the top, there's a brief statement of qualification about sustainable capital finance to give the off-taker confidence in our abilities to finance this particular project. Afterwards, there's a section containing project parameters for solar, storage, as well as electric vehicle charging highlights specific to this particular project. All these project inputs are collected in the project details and off-taker information tab in the SCF Suite. It contains information like EV charging rate, the annual escalator, as well as the revenue share offered to the host. There's also a table that breaks down year by year what the anticipated revenue share is for the host. And lastly, there's a project timeline highlighting the anticipated schedule to get the project placed in service. The preliminary proposal can be a useful resource alongside an SCF project analyst in order to ensure confidence with our property owner to move forward with the project. If you have any questions on the preliminary proposal, you can always ask your project analyst prior to sharing with the property owner. Another resource we wanted to share with you and your EV charging prospects is our EVCS One Pager. This One Pager can be downloaded directly from the documents library in the SCF Suite and can be shared with prospective customers to gauge and increase interest. It's very straightforward and enables clearly defined benefits to going forward with an electric vehicle charging solution with sustainable capital finance. And apologies, that was my golden retriever barking. Hope he doesn't do that again. And so this is a very useful resource if you want to get this in front of a lead or an early stage customer to gauge interest and to move them forward with eventually a preliminary proposal, a term sheet, and the revenue share agreement. So with that, we are finished with our presentation portion of our webinar, and we thank you so much for listening so far. And we're going to transition over to our Q&A session. So if you have a question, you haven't submitted it yet, go ahead and type it in and we'll answer it in the order of which received. And if we're unable to answer all the questions during this short Q&A session, we'll be sure to add them to the FAQ session in the SCF Suite. So feel free to check that out in the Support Center. So let's jump in. Thank you.
Okay, so the first question that we have is from Daniel Boyd. It's about the EV charger cost assumptions that we had broken down on the costs. Said $234,000 for a charger is more than what we were seeing. That's actually for 4 fast chargers, not 1 fast charger. So that's just a numbers count. So thank you for that question, Daniel. What specific territories and regions in the US are currently most attractive for electric vehicle charging infrastructure? So definitely California is the #1 market. There are lots of incentives both at the local level and the county level, as well as the utility level. And as well as with high demand charges and other types of rate structures, there's ways to structure solar plus storage plus EV charging to make overall the value proposition very, very strong for the customers. Let's go ahead to the next question. Do the financials make sense with just solar plus electric vehicle charging? Yeah, that's a great question. So traditionally, sustainable capital finance acts as a PPA financier. So traditionally, our solar assets are structured as power purchase agreements. One of the benefits that you have by adding energy storage is that flexibility of utilizing cheap solar energy to charge those EVs. If you take out that energy storage, you're relying on the customer essentially load as well as the solar load to help kind of shape that load profile. And it doesn't essentially have the same flexibility, but it's absolutely something that we can explore, particularly in markets where energy storage incentives aren't as attractive. So if you're not familiar, but California has the self-generation incentive program. It's very, very attractive still to this day for energy storage assets. And that helps to cover substantial portions of the cost. But in other markets, those storage incentives may not be there. So it really applies on a case-by-case basis and really can go down all the way to the county level when it comes to local incentives. Dan, do you want to take the question on level 2 chargers?
Sure. So the question is, do we finance level 2 chargers? The answer is yes, but not typically in the fashion that we've just presented. This level 3 charging infrastructure plan that we're showing you today is really based on the input that level 3 charging is substantially more expensive than level 2 charging. So for level 3 chargers, we've put together kind of a unique structure for those. For level 2 charging in general, if you've got a solar project and you want to add some level 2 charging, because it's relatively inexpensive in nature, oftentimes we can just throw that into the total budget and see if we can make it work that way.
Okay, thank you, Dan. Can we run another one after this without the California incentive from Patrick? Absolutely able to do that. We can go ahead and schedule essentially a quick demo or a webinar. I can provide you my calendar. You have my email address right here, and we can set up some time to run through an example as well. But yeah, we could definitely structure essentially a model with no energy storage incentives or EVCS incentives as well. I'm going to take a question from Norm. So how does the model work for a retailer that leases the building space? Yeah, that's a great question. So ultimately, when we're underwriting, we're going to focus on underwriting with the property owner. Now, if the tenant lease agreement is 10 years or more, there should be no conflict because our term lengths are typically 10 years. However, if the tenant term length is, let's say, 5 years, there's a remaining 5 years, we will need to work with both the tenant and the property owner to assure that there's an assignability of that particular contract, revenue share contract with the property owner or the next tenant that it'll be assigned to. So that's a great question. It's really kind of dependent on the retail space tenant term length, but ideally it's going to be 10 years or more, because our term lengths for these are structured as 10 years with options to essentially renew or for us to essentially remove the system. One thing to note is, our traditional solar power purchase agreements and solar plus storage power purchase agreements range from anywhere from 15 to 30 years. And so by adding this electric vehicle charging infrastructure, we're able to shorten these term lengths to something that's a little bit more manageable for, board approvals and other approval processes to get behind versus, a long 30-year term, which not every off-taker is interested in signing up for. So by adding electric vehicle charging infrastructure, we're definitely able to shorten that term length, and that can also accommodate that tenant lease term much more easily. Dan, go ahead with the next one.
Yeah, there was a question on standardization, and really the question between, say, like Tesla chargers and kind of the more standardized ports that are available. Tesla has their own network, and we don't play in that space. That is a completely closed infrastructure. So everything we would be doing would be on the open standard side, and we believe that will ultimately be the larger portion of the market going forward, as the majority, or if not all, of the major car manufacturers are releasing their EV versions either now or in the next year or two. So that's the market that we're looking at, and like I said before, level 3 charging is our primary focus currently.
Sure, I'll take the next one. What is the charging rate based off of the quick quote model? That's a great question. You'll see it in the bottom right corner when you open up quick quote, all the assumptions that are brought in. It is currently at 39 cents per kilowatt hour. Now we can easily calibrate that down or up depending on the market and the specific demand in that particular market. But 39 cents is a pretty stable kind of benchmark that we feel pretty confident in. I'll take another good question from Eddie. Based on earlier installations, what is a reasonable revenue share per client? So right now, what we have shown to support is anywhere from 3 to 10%, with 8% kind of being the benchmark we're trying to hit more frequently. That's a very attractive proposition, as I showed in the previous example. For 4 fast chargers across 5 sites, you're talking about $100,000 per year. Which is very, very attractive for the customer as well. That's a great question. And are you assuming, Jasmine, this is a great question, Yasmin, and it can apply to multiple ones, but are you assuming connectivity to the grid or off grid for solar plus storage EV chargers? And then this ties in with another question with regards to project timelines. And one of the major timeline factors that we're all aware of as solar and storage developers is interconnection. And if you can forego interconnection and essentially do off-grid, there are ways to speed up that approval process. There are additional permitting requirements as needed. However, that can definitely speed up if you're removing the interconnection timeline, that can definitely speed it up. However, most of the assumptions that we're making is traditionally with interconnected systems. And that is also just because we're also utilizing, substantial solar to help offset not only usage of the chargers, but ideally load on site. So on-site load. So if the customer or if the client is, consuming 1 million kilowatt hours annually, we're hoping to shed some of that load before we, slap on 4 fast chargers that might spike up additional consumption. So we're trying to, increase solar and utilize solar as a way to generate cheap power. And that's a way for us. So on the interconnection side, that definitely can be a challenge. But when it comes to overall project timeline, what I displayed in our process is typically a 30 to 45 day until agreement execution. And then the typical timeline after that is a traditional solar development timeline. So you're looking at filing for permitting and interconnection as needed. and essentially getting all the engineering designs in hand so that we can issue notice to proceed. So, traditional solar projects can be anywhere from 3 months to 18 months, depending on number of sites, number of installs, types of installs, as well, and just overall size of the project. By utilizing this electric vehicle charging solution, we're hoping to come down a little bit with smaller solar installations, which could be installed faster. So we're hoping that we can bring that on that timeline closer to 3 to 6 months for installation. We mentioned California as being the best market. Are there some others you are working in? We're mostly East Coast installers. Dan, do you want to take that one?
Sure. So excellent question. The short answer is that we're starting in California only because the incentive structures here are so strong and make the vast majority of the projects we look at very viable. We are looking intensely right now at the East Coast, primarily states like New York, New Jersey, Massachusetts, as areas where we want to expand into next. However, we're going through the full vetting process of this technology and getting through all the paperwork and understanding the market further in depth. So we feel like California is where we want to be right now. But in the next, I would say 3 months, we're hoping to expand that into a broader offering across the East Coast as well.
Yeah, and I'll add on to that. So in New York, there are quite a few incentives for EV charging. The Con Edison Commercial EVC incentive, Charge Ready New York, National Grid's per plug incentive program, and PSEG. Pennsylvania also has some incentives, as well as Rhode Island and New Jersey. It pays to plug in program. Little pun on words there. But yeah, so we're definitely, as Dan mentioned, California is really just the most ready market, particularly on the fast track with energy storage incentives as well, and just the simplification for interconnection approval. But definitely, we're always hoping to expand more on the East Coast, particularly in the New York, New Jersey, Maryland, New England region. Absolutely. So that's a great question. And we're traditionally, still supporting solar standalone in the East Coast as well as solar plus storage where there is a use case. I'll take a few more questions. I know we're kind of running towards the back end. So have you worked with additional ancillary services like frequency reg into our model? Yeah, that's a great question. So typically not frequency reg when you're talking about on the energy storage side. Traditionally, we're looking for demand shaving when we're using our kind of solar plus storage power purchase agreement model. We're essentially trying to justify and model an expected increase in savings and whether or not energy storage savings are accretive to the overall project. So when storage savings are not accretive, we will typically recommend exclusively utilizing solar. But if storage adds some accretive savings capabilities, it's definitely something we want to explore, especially for our storage PPAs. However, for our EVCS solution, storage is going to be largely as a role of storing cheap solar energy and utilizing that, and also just managing demand spikes, which are going to be relevant when you're talking about 3 to 4 fast chargers located on site. We want to make sure that we're not increasing demand spikes on site and therefore potentially increasing the overall energy spend of a property owner. But that's a great question.
Joel, there's 2 questions here from Chris I wanted to address.
Go ahead.
One of them here is there a minimum number of charges the property owner or tenant needs to commit to contractually? Excellent question. The answer is no. We've put together a model that does not require them to basically backstop anything on the minimum number of charges. And then the second question Chris brought up was, what's the typical term? Is it 10 years? In general, 10 years would be the goal. It doesn't mean that will work in every situation. Every situation is somewhat unique, but 10 to 15, I think, is the typical range that we're going to be seeing.
Yeah, and one thing to point out, this is pretty big, is when is this going to be live on the SCF Suite? So we're planning for a Monday launch, which is pretty exciting for us. You'll essentially see that additional project type being added to the quick quote option. So historically, you've only seen solar and solar plus storage power purchase agreements, and now you'll see that additional project type come Monday. And the summary page will be slightly different, with essentially savings not being shown, but a revenue model, as well as the preliminary proposal will be modified specifically for EV charging solutions. So we will still have our traditional solar and solar plus storage PPA proposals, as well as our EVCS proposal. But great question, thank you. And I'm trying to just scroll through really quick if there's any other questions. Like I mentioned earlier, we will add these questions to the FAQ section of our SCF Suite Support Center. So if you haven't had your questions answered, that's a good place to look. Otherwise, you have both Dan and myself, my contact information listed above, and feel free to reach out to us. We're readily available. Dan is actually going on vacation tomorrow, so go ahead and ping me for the next 10 days or so, and I'm happy to get back to you. But with that, I think we've hit every question. We have, oh, do the stations have to be staffed, or are they largely self-served? They are self-served, all of them. So that's going to be the mode that we're going to operate these, and that's just a way to reduce overall operational expenses. And as Dan mentioned, these are 30-minute chargings, so at a minimum. So typically, the customer is going to come on site, plug in their car, and go into either the retail store or whatever the location is sited at, and spend time and potentially money. So as Dan mentioned earlier, it's a great avenue for bringing on additional business to that property owner, and that's something that can be easily sold and conveyed. So yeah, great question. What is the commission structure on a project like this? So we typically pay our developers through a milestone disbursement agreement program through essentially our EPC, engineering, procurement, and construction agreement. That is how our developers get paid. If we have a specific originator that is not fulfilling a developer installer role, and they're acting as essentially a liaison to a property owner or a property ownership group, we do have a separate origination agreement that has kind of a reduced percentage based off of level of involvement in the origination role. But yeah, in terms of the developer fees, when modeling for all of our quick quote projects, we recommend you incorporate your developer fees, your install fees, the equipment costs, everything essentially, so the total cost per watt on the solar side, as well as energy storage. And that way the model reflects what the true terms that we can support is, and that way you don't add any commission fees later and modify the overall project terms, so we don't have to go back to the customer, because that can always be confusing. So once again, just always recommend putting in kind of the total project cost in on a cost per watt basis on the solar side, cost per kilowatt hour side for energy storage, and then as Dan mentioned, we will be incorporating the EVC costs for ourselves. And we do have a list of tier 1 electric vehicle chargers on that quick quote. If you do have an electric vehicle charging manufacturer that you plan on utilizing that is not on that list, essentially what we'll request is more information about that manufacturer. We will reach out to the manufacturer, get their warranty letters, spec sheets, and essentially assess if they're going to be deemed as tier 1 or not. So that's a great question there. Dan, do you want to take the question from Joey?
There's a question about does the contract put a lien on the property? Honestly, I'm going to have to get back to you on that. I don't know the answer on that. So let me check with my ops team, and we'll shoot you an email.
And then Joey had another good question, essentially how the price per kilowatt hour for the EV charging pricing is generated. So as I mentioned earlier, we have an assumption right now of 39 cents per kilowatt hour with an annual escalator built in. But once again, that can be calibrated to market specific trends, right? So if New York EV charging, fast charging is set at 35 cents, we could definitely calibrate that down so that we can accurately reflect that particular market. But as of now, for California, 39 cents appears to be the benchmark for that. And also, can you as the developer own the EV charging stations? Unfortunately not. We at SCF as third-party financiers will act as the owner operators and asset managers throughout the length of the term with our relationship with NextEra Distributed Generation. So Dan mentioned that earlier, but we have a long-standing relationship with NextEra, and they would be the long-term owner operators. And so unfortunately, we do not provide kind of a loan product to cover the cost of the system while another owner operates it. So with that, I think we're going to wrap it up. But if there are any other questions, once again, feel free to reach out to me at jbinstock@scf.com. From myself and Dan and our whole team at SCF, we're really excited about this particular solution because it helps us, reach a new market, particularly on the smaller solar projects that maybe you couldn't fit 500 kilowatts and only 200 kilowatts can go there. Well, let's explore adding EV charging solutions and energy storage to make a more comprehensive solution for the property owners. So with that, we really want to thank you. And once again, a recording of this will be made available to all of you either at the end of today or sometime tomorrow. So with that, thank you again. And we look forward to working with you guys on our electric vehicle charging solutions.